They tell you silver is just another metal, a byproduct, a relic. That is the first lie. The second lie is the price. Because the price you see on a screen is not the price of silver. It is the price of a paper abstraction designed to suppress signal. A placeholder, a distraction. And the third lie is the most dangerous. They tell you demand is flat. That technology will innovate around constraints. That supply will respond. It won't. This isn't theory. This is chemistry. This is physics. This is published data buried in footnotes no one reads. Somewhere between quarterly earnings calls and AI hype reels, something quiet happened. No headlines. No urgency. Just contracts. Memorandums. Quiet site visits to remote jurisdictions with poor roads and good geology. Big tech didn't announce a pivot. They never do. They moved upstream. Because the lab always leads the chart. Every artificial intelligence system, every data center, every neural accelerator being deployed at scale runs into the same wall. Conductivity, thermal management, signal integrity. You cannot cheat the periodic table. Silver is not used because it is fashionable. It is used because nothing replaces it at scale without loss. Higher resistance means more heat. More heat means more cooling. More cooling means more power. More power means exponential cost. This isn't ideology. This is math they refuse to run in public. AI is not software. It is an industrial process disguised as code. It consumes electrons the way blast furnaces consume coal. And electrons demand pathways. Silver is the best electrical conductor humanity has ever measured. Not one of. The best. That property is not optional. It is fundamental. Every GPU rack upgrade increases silver loading. Every efficiency gain increases density. Every density increase tightens tolerances. Every tolerance reduction eliminates substitutes. The engineers know this. Procurement knows this. Risk management knows this. The market doesn't. Silver mining is not elastic. You do not flip a switch and get more silver. 70% of global supply is a byproduct of other metals. That means silver output depends on zinc demand, lead demand, copper demand. You cannot mine silver because silver is expensive. You mine it because something else is. This creates a structural delay that paper models ignore. Price rises do not summon supply. They expose absence. Meanwhile, above-ground inventories are drawn down quietly, not panicked, not loudly, methodically. They don't need all the silver. They just need to control the marginal tonnage, the portion that sets price. That is how commodity shocks begin. Not with shortages, with tightness, then with delivery friction, then with temporary dislocations. We've seen this movie before. The analysts were a decade late because they modeled sentiment instead of molecules. The public narrative still says solar. Jewelry, coins, that is the decoy. The real pressure is invisible. Inside server farms, inside defense systems, inside autonomous platforms that cannot tolerate latency or failure. AI does not tolerate compromise. And silver is not negotiable. The price chart tells you nothing about this. Because the price chart is dominated by leverage. Paper claims outnumber physical ounces by orders of magnitude. That only works as long as no one asks for delivery. Big tech does not speculate. They secure supply. So they don't buy ETFs. They don't chase futures. They sign offtake agreements. They invest quietly in marginal mines. They fund expansions that will not produce for 7 to 10 years. That timeline matters because AI deployment is accelerating now. Not in a decade. Now, this creates a temporal mismatch the market cannot resolve gracefully. Short-term demand, long-term supply, a widening gap bridged only by inventory drawdown. Once inventories are gone, price stops being theoretical. You are being shown volatility to distract you from inevitability. Down days framed as weakness. Pullbacks framed as failure. They are discounts created by structure, not signal. Every ounce sold today is an ounce not available tomorrow. And tomorrow's demand is not optional. It is contractually obligated. Embedded in CAPEX plans already approved. This is not about belief. It is about positioning. The institutions will tell you silver is volatile. They say that because volatility keeps you out. They prefer markets where participation is thin and leverage is deep. But volatility disappears when physical control tightens. It always does. At first, it looks like nothing. Then it looks like noise. Then it looks like a mistake. By the time it looks obvious, access is gone. There are documents that never reach the press. Internal stress tests. Failure mode analysis. Scenarios where a single input constraint cascades across entire systems. Silver shows up in all of them. Not as a line item. as a bottleneck. Because when resistance increases, systems fail nonlinearly, and nonlinear failure terrifies engineers. So they act early, quietly, upstream. This is why mines with mediocre grades suddenly receive funding. Why jurisdictions, once considered marginal, are re-evaluated. Why exploration budgets rise even as spot prices fall. This is not contradiction. It is signal. Paper traders respond to charts. Industrial buyers respond to physics. And physics doesn't care about narratives. They will tell you substitution is coming. That copper will replace silver. That graphene will save the day. Copper cannot match silver's conductivity without size penalties that AI architectures cannot afford. Graphene is not scalable at industrial volumes at acceptable yields. This is published data. It is not secret. It is just inconvenient. Silver demand is inelastic because performance standards are rising, not falling, and rising standards compress material choices. At the same time, ore grades decline. Energy costs rise, permitting timelines stretch. This is how scarcity is manufactured by reality itself, not by conspiracy, by constraints. Institutions are trained to respond, not anticipate. They need confirmation. They need trend validation. They need permission. You don't. You are not being asked to predict timing. You are being asked to recognize direction. The lab always leads the chart. The mine always lags demand. When the price finally reflects this, it will not ask who was ready. It will simply move. And when it moves, it will not be because sentiment changed. It will be because inventory disappeared. Silver does not need belief. It needs absence. The moment physical flows tighten beyond tolerance, paper unwinds violently. Claims rush toward delivery points that no longer exist. This is when volatility spikes upward, not downward. This is when price becomes irrelevant to procurement. Because supply security overrides cost, you are being conditioned to fear drops, to celebrate stability, to wait for clarity. Clarity is what comes after repricing. Those buying now are not gamblers. They are hedging inevitability. The quiet accumulation will continue until it can't. Until someone asks the wrong question. Until delivery is delayed. Until a contract is settled in cash instead of metal. That is when the narrative breaks. Not with news. With failure. No alarms. No countdowns. Just a slow realization that the screen price was never the real one. By the time institutions pivot, the window closes. It always does. Nothing about this requires urgency from you. Only patience. Only conviction rooted in reality. Events are already in motion. Contracts already signed. Minds already spoken for. The silver doesn't care who understands it first, but the outcome rewards those who do. This is not a trade. It is alignment with physics, and physics always wins. The mistake most people make is assuming the system will warn them before it breaks. It never does. Industrial systems fail quietly first, in spreadsheets, in procurement emails, in clauses that quietly change from delivery guaranteed to best efforts. That language matters, because best efforts is what you write when you already know something is wrong. Silver does not disappear overnight. It thins. It fragments. It becomes allocated before it becomes scarce. An allocation is invisible to the public. A refinery doesn't announce it has prioritized one buyer over another. A mine doesn't issue a press release when future production is already spoken for. A tech firm doesn't explain why it suddenly wants exposure to jurisdictions it ignored for decades. They just move. This is where psychology collapses for most observers. They look at price and assume causality flows from the screen to reality. It doesn't. It flows the other way. Price is the echo. Reality is the sound. AI deployment schedules are not flexible. They are locked years in advance. CAPEX is committed. Facilities are under construction. Power agreements are signed. You don't slow that machine because one input becomes inconvenient. You secure the input. This is why silver demand doesn't spike gradually. It steps. One architecture revision. One density threshold crossed. One thermal limit reached. Suddenly, silver loading per unit rises. Not because someone wanted it to, but because failure rates demanded it. This is the part no one models. They assume linearity. Reality operates in thresholds. Below a certain conductivity, systems work. Above a certain resistance, they don't. That cliff exists, and we are moving toward it. The public narrative still frames silver as cyclical, tied to growth, sensitive to rates. That framing is obsolete. What matters now is function. Silver is not an input you optimize away when margins tighten. It is an input you protect because failure costs more than metal. That is why institutional demand will not show up as speculative buying. It will show up as silence. Fewer ounces offered, longer lead times, more cash settlements. When paper markets decouple from physical reality, the adjustment is never smooth. It snaps. The suppression only works when excess exists. When above-ground stocks can absorb stress, those stocks are finite. Every year of deficit erodes the buffer. And deficits don't announce themselves with fireworks. They accumulate like pressure in a sealed vessel. Eventually, the weakest seam gives way. People ask why this hasn't happened already. That question misunderstands scale. AI is not one product cycle. It is an infrastructure build-out, comparable to electrification, to industrialization. Those shifts did not reprice inputs overnight. They did it suddenly, after years of quiet strain. The analysts always arrive after the inflection, because their models depend on backward-looking data. And backward-looking data never captures approaching constraint. Silver's problem is not demand growth, it is demand certainty. When demand is optional, price negotiates. When demand is mandatory, price obeys. AI does not negotiate. There is no wait and see phase when competitive advantage is at stake. There is no pause button when latency determines dominance. So the buyers who matter act before price signals turn obvious. They accept temporary losses. They ignore volatility. They think in systems, not quarters. That is why price weakness is misread as failure. It is actually evidence of absorption. Metal leaving weak hands, moving into strong ones. Hands that do not sell. The market teaches people to confuse motion with meaning. Down equals bad. Up equals good. That heuristic fails in structural shortages. In those environments, down is distribution. Up is panic. The smart money wants neither. They want quiet. And quiet is exactly what this market has been. No mania. No headlines. No retail frenzy. Just persistent drawdown against a rising industrial curve. You don't need secret information to see this. You need to ignore noise. Look at mine development timelines. Look at declining ore grades. Look at energy intensity per ounce. Those are not opinions. Those are constraints. At the same time, look at where technology is going. Higher frequency. Higher density. Lower tolerance for error. That combination has only one outcome. The idea that recycling will save the market is another comfort story. Recycling responds to price. Price lags shortage. You cannot recycle what hasn't been discarded, and high-performance silver doesn't get thrown away casually. Recycling is a pressure valve, not a solution. The system needs new metal. And new metal takes time. Years of time we no longer have. This is why the narrative will shift suddenly, not gradually. One day, silver will still be boring. The next, it will be strategic. That reclassification changes everything. Strategic materials do not trade like commodities. They are secured like assets. When that happens, liquidity vanishes, and price becomes whatever is required to dislodge supply. This is not a prediction. It is a pattern. The only question is who recognizes it before the language changes. Because once governments, institutions, and corporations start speaking about security of supply, the window is already closing. By then, the easy ounces are gone. The cheap contracts are signed. The leverage shifts permanently. Until that moment, doubt will dominate. That is how these transitions work. The market must make participation emotionally difficult. Otherwise, everyone would arrive early. Your advantage is not foresight. It is composure. The ability to sit with mispricing without needing validation. The ability to trust structure over sentiment. Nothing about this requires action today. But everything about it punishes hesitation later. The pressure is building, not in headlines, in inventories. And inventories do not lie. They simply run out. When they do, the conversation changes. Not because people became smarter, but because reality removed alternatives. At that point, the repricing feels sudden, violent, unfair. But it was never sudden. It was only ignored. Those who understood did not need to rush. They only needed to wait. And waiting is easier when you know how the system ends. Because this system ends the same way all material constraints do. With acknowledgement, not apology, not explanation, just acceptance. Acceptance that the price was wrong. Acceptance that supply cannot be summoned. Acceptance that physics always collects its debt. And when that acceptance arrives, there is no negotiation left. Only settlement. In metal, there is a moment in every structural shift when the argument ends without being resolved. Not because one side wins, but because reality removes the debate. That moment is approaching. Not announced, not televised, not accompanied by a bell. It arrives as friction, a shipment that doesn't clear on time, a delivery window that quietly stretches, a clause rewritten to protect the seller, not the buyer. At first, it's blamed on logistics, then on regulation, then on geopolitics. Those are surface explanations. The cause is deeper. Silver is being consumed faster than it can be replaced. Not consumed emotionally, consumed physically. Every wafer, every circuit, every system that cannot fail. This is not hoarding. It is provisioning. Hoarding implies excess. This is preparation for continuity. The mistake is thinking this is about one technology. It isn't. AI is simply the first system large enough to expose the constraint. Once exposed, it doesn't disappear. Other industries will collide with the same wall. Defense, energy transmission, medical imaging. All of them depend on reliability at scale. All of them converge on the same material reality. Silver sits at that intersection quietly. Unbranded, uncelebrated. That is why it is mispriced. Markets price stories well. They price necessities poorly. Because necessity doesn't advertise itself. It asserts itself. The paper market exists to smooth perception, to create the illusion of abundance, to delay recognition. It works until it doesn't. When physical demand becomes non-negotiable, paper becomes irrelevant. Claims are only valuable if they can be honored, and honor requires inventory. This is where leverage becomes poison. Not for the holders of metal, for the writers of promises. At that stage, volatility doesn't scare buyers. It scares sellers. Because sellers discover they no longer control the exit. That shift has already begun. Quietly. You can see it in who refuses to sell forward, in who demands escalation clauses, in who accepts price risk but not delivery risk. Those behaviors don't show up in charts. They show up in contracts. The public will notice only when the language changes, when commentators start using words like unexpected, sudden, unforeseen. Those words mean one thing. They were not paying attention. Nothing about this is sudden. It has been building ounce by ounce, year by year, under a narrative designed to keep attention elsewhere. Silver doesn't need to be loved. It needs to be required. And it already is. The repricing, when it comes, will not feel like victory. It will feel like inevitability. No euphoria. No celebration. Just a quiet recalibration where numbers adjust to reality and move on. By then, the discussion will shift to blame. Who didn't warn? Who missed it? Who should have acted sooner? Those conversations are for latecomers. Those who understood never needed validation. They never needed timing perfection. They needed alignment. Alignment with constraints that do not bend. With supply chains that do not accelerate on command. With physics that does not negotiate. This is not about optimism. It is about orientation. Facing forward while others look sideways. Listening to engineers instead of commentators. Watching inventories instead of opinions. The noise will continue until it can't. Until price no longer responds to reassurance. Until volatility no longer shakes supply loose. At that point, calm replaces confusion. Not because the world became safer, but because uncertainty resolved. Resolution always favors those who were already positioned mentally. There is nothing dramatic left to do. No rush. No panic. Only the discipline to ignore misdirection and trust structure. Silver will not announce its moment. It will simply arrive there. And when it does, the story ends the same way all material stories end. With acceptance. Acceptance that some things cannot be engineered away. Acceptance that scarcity is not a narrative failure, but a physical one. Acceptance that the price was never the truth. The truth was always in the metal, and the metal was always leaving.